Welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. At Investor in the Family Radio, we believe that every dollar and minute we spend is an investment in something, and together we want to make the best investments that we can. So thank you so much for joining us. And on today's show, a lot of fun. We have Lynn, also known as Dividend House on Seeking Alpha. Lynn has been investing for over 30 years, but more recently began taking a much more hands-on approach to her investments, hers and her husband's, I should say. And in this interview, she dives into all the details of what it means for her to be a dividend growth investor, also known as DGI investor. She talks about how she built her investing approach, how she went from little investing experience to becoming a teacher of others, why Seeking Alpha has such a rich and engaged DGI community, which is a really fun conversation, how she builds her portfolio like a house. When she has parts of her portfolio she describes as a foundation, the walls, the roof garden, and even a doghouse, why she holds over 65 stocks in her portfolio, her 9-part criteria for selecting investments, how dividend stocks are like rental properties, and lots of other fun stuff, as well as some wisdom for new investors. So you don't want to miss this podcast with Dividend House. Lots of fun. Remember, our goal here is to help you learn to invest. That's financially and in all of life. You can always find more at investorinthefamily.com. Also, in less than 1 month, just a few weeks from now, we're going to have the second online investing conference. And it kicks off on September 12th. This conference is fully online, no travel required, anything like that at all. And it will feature 3 top growth-focused investors, each sharing their current top 2 highest conviction investments. And these are picks and research that are normally reserved for their premium paid subscribers. And to be a premium paid subscribers for these investors will cost you easily hundreds, if not thousands of dollars. But for this conference, you're getting their 2 premium highest conviction picks for free for a short period of time. And headlining this fall's conference is Brett Jensen and Cody Willard and another investor still to be announced. And again, the conference is currently free for a limited time, a few days before it goes live on September 12th. The free window will close and the price will jump to $99. So don't miss this opportunity. Go to onlineinvestingconference.com. That's onlineinvestingconference.com, and be sure and sign up there for free. Or you can text the word join family, one word, join family, to the number 44222, and you'll get on the email list, and I will send you all the information you need about getting registered for the conference. And also there should be links to the conference either in the show notes to this podcast or on the page dedicated to this podcast on my website if you can't find it anywhere else. So be sure and check it out there, and I hope you enjoyed today's interview with Lynn, also known as Dividend House. Well, hey, Lynn, welcome to the show.
Hi, Brian. Great to be here.
Well, it's an honor to have you here. Really appreciate you being willing to give us some time this afternoon. And I'd love to get started. Do you mind sharing with our audience a little bit about your background as an investor and kind of what you're doing now investing-wise?
Sure, be happy to. Basically, my husband and I have been in the stock market on and off for for about 3 decades. And actually for him, more than that, a lot longer than that, probably 50 years or so. And basically we did the ostrich approach to investing, I like to call it, where we stuck our head in the sand, picked a few mutual funds every time we moved to a new company in our 401k, and then just ignored it. And so about 5 or 6 years ago, when my husband made the announcement that he was going to retire in the next 5 to 6 years at that point in time, actually we've extended that timeline, when he first made that announcement, we had this crazy patchwork of 401ks from all over the place, from all of our previous employers and our current employers. Nothing fit together. There was no strategy. It was a real mess. We had it sprinkled over all kinds of different firms, like from Vanguard to Fidelity to TIAA CREF. So when he made the announcement that out of the blue, although I should have seen it coming, that he wanted to retire, pretty soon, I knew we needed to get our act together and stop being quite so passive in terms of just throwing things in mutual funds and start figuring out how we were going to generate an income stream from our investments. So we went from your typical kind of, person who really wasn't paying attention to our investments to people who really now are very much self-directed investors. We've transitioned everything that we can into brokerage accounts so that we can acquire individual dividend growth stocks. We can't do that with some of our current employer's 401k funds because they don't allow that self-directed investing into individual stocks. So we still do have some mutual funds due to that restriction. But everything else we have converted over into dividend growth investing in the last about 2.5, 3 years now.
So you took all those 401ks and basically just rolled them over in their brokerage accounts. Is that basically as simply as what you did?
Yeah, we rolled them over we did one by one as we learned and as we, started figuring out what kinds of things we wanted to be in. So we would take an account, roll it over into a 401k that we could then, have as a brokerage account and then start buying stocks with it. So yes, we did do that. It took quite some time. It took about almost a year to get everything rolled over that we can roll over. Yeah,
I was going to ask how difficult of a process that was, because that can be, I guess in some cases it can be smooth, but also it can be a little sticky as well.
Yeah, well, I actually wrote an article on Seeking Alpha about it called How to Convert Your Retirement Portfolio from Mutual Funds to Dividend Growth Stocks. And it really kind of takes people through the process of what we were doing as we were doing it in terms of getting things rolled over. And yeah, I was not comfortable doing that until I had an approach in mind about what the portfolio should look like, at least on a broad level. What did I mean by a core stock versus, say, a supporting stock versus an auxiliary position? So I really had to sort of understand where I was going before I was willing to then start making that transition. So we started out with a dividend growth investing plan, figuring out where we wanted to get to, and then we had a target in sight. We could then start doing the rollover process. And it takes a long time. Just moving things, one of the things we wanted to do was get down to a lot fewer investment financial companies to work with. And so pulling funds out of certain investment companies and into other ones, that alone just takes a while for the companies to get the paperwork done and to get that transition to happen. So it does, you do need to give yourself plenty of time if you are planning to embark upon an approach like that.
How did you go about building your approach to investing?
Well, I did a ton of research and a ton of reading. Thank goodness I found Seeking Alpha, because there are so many good writers that talk about their own approach to dividend growth investing, really from a conceptual level. And that's really what we were talking about, at the beginning, why do dividend growth investing, and then how to construct a portfolio to do it, what things to look at. And so actually, I also wrote an article talking about our dividend growth investing portfolio plan. One of the tenets is to really develop a plan, again, so you kind of know where you're headed, so that you can then take the steps to get there. And so you really have to learn how to do stock screening in a way that really fits your risk tolerance. You have to figure out how to do valuation in a way that, again, is comfortable, where you're comfortable buying in at a fair value or below. And then, of course, I think the question that you're really asking is all about the portfolio balance and the structure of the portfolio itself. Yeah, so there's those three areas, and there's lots of articles on all of those areas on Seeking Alpha. For us, I ended up coming up with a 9-step approach, and I've written about that approach from time to time throughout the time I've been writing on Seeking Alpha. And it has evolved. As I learn, I have mostly added criteria. I'm an electrical engineer by training, and that was my first career. So I really like to quantify things when I can. And I also have an MBA, and that's another area that likes to quantify things when you can.
Right.
So I really like that sort of way of thinking. And so I definitely have the last article I wrote on the subject was called A Swan Decision Tree for Selecting DGI Stocks. And it really goes through the steps that I take to figure out how I screen stocks. I also have articles on the portfolio structure. My portfolio structure really is in 3 levels. As you may know, we call the portfolio the Dividend House Retirement Portfolio. And the Dividend House itself is made up of a foundation, and those are the core stocks. It's made up of the walls, and those are the supporting positions. And the roof stocks are our auxiliary positions. And so those, every time I buy a stock, with a couple of exceptions, I'm buying to fit one of those three categories. One of the exceptions to that rule is our garden. The garden outside the dividend house is where our speculative stocks are, kind of in the realm of, let some flowers bloom. So even those are dividend growth stocks, but they're not stocks that we're expecting to be heavy on the income because they are more growth than income oriented. So biotech stocks and Comcast. So our biotech stocks, which we have Amgen and Gilead, and we also have one other biotech that's slipping my mind, and then we also have Comcast in that area. So those are the stocks that we put in the garden, and AbbVie, of course. AbbVie is the other speculative stock. So unless we're buying for a speculative reason, we really buy to have stocks be in the dividend house to really make up the income we need for our retirement. We do have a fifth category, and that's our doghouse. The doghouse is the fifth category. Yeah, the doghouse is for the stocks that we bought for the house, but they got kicked to the curb because for some reason or other they weren't performing. I have some Walmart. Walmart is in the doghouse, for example. Walmart is a stock, as many of us know, that originally was bought thinking the dividend growth would be much more robust than it has been in the last 3 or so years. They've only done a 2% dividend growth increase for the 2% worth for the last 3 years each. So that's not exactly a very good, strong dividend grower. And of course, the yield itself is not all that high. So you put the two together, and it's not really meeting the portfolio goals that we set out for stocks in the house. So it's in the doghouse. And as the price goes up and meets my break even, I sell off tranches of the stock. So I am looking to usually actively get out of my doghouse stocks, and Walmart's a perfect example of that.
Okay, so you use terms like core, supporting, auxiliary, speculative, and then kicked to the curb stocks, which I love. Are those pretty common words and ways of approaching a portfolio in the DGI community?
They are. Core, supporting, and auxiliary. You'll see those words. Some people, clearly, not everyone. There are people out there, by the way, who pursue dividend growth investing, and they just weight every stock equally that's in their portfolio. So they don't really make this differentiation. But there are a lot of us who do. And a lot of people have 2 or 3 or more categories. So yes, you do see the word core stock quite often, or foundational stock. Those two terms are used sort of interchangeably. The supporting stocks you do see a lot, and then you'll see some people talk about their auxiliary positions as well. You have to be careful and know who you're reading. For some people, the auxiliary stocks may be more speculative than they are for me. I call my speculative stocks speculative. I just come right out with it. And some people tend to, mask that term a little bit.
So tell me, okay, so a core stocks or supporting stocks, is that defined, I guess, probably position size? And then also what criteria go into being a core foundation stock for you?
Yeah. So, in fact, I'll pull up one of my articles on that, just to make sure I keep myself honest here. I do have an article on Seeking Alpha that actually is called "How We Decide Which DGI Stocks Are Core Supporting and Auxiliary." Oh,
perfect.
So, because and my philosophy here is I'm just documenting what I do. I'm not a financial advisor. I am just learning how to do this, as I do it. And I'm just laying out my thoughts so that other people can learn from my successes and my mistakes. And as I'm learning. And I find that that's very helpful as I learn from other people doing the same thing. I do have 9 criteria that I use to decide, how attractive a stock is. And it includes things like how many years of increasing dividends there are. So if a stock has increased its dividends for, say, 20 or 25 years, they've either become a champion or a dividend aristocrat, 20 years being a champion, 25 years being a dividend aristocrat, then I would be more likely to include them as a core stock, for example. If they have, say between 10 and 24 years of increasing dividends, they're called a contender, a dividend contender. And they're more likely to be considered first to be a supporting stock. And I'll tell you, there are exceptions to this rule, but these are guidelines. They're not rules, really. Then if a stock has less than 10 years, then they're more likely to join the portfolio as an auxiliary or a stock on the roof. And that's an example of one of the criteria I use. I do have 9 of them. I also look at credit rating. I also look at debt to total capital. I look at payout ratios, which is the dividend payout ratio. That's how much dividend gets paid out of the earnings of a stock. Mm-hmm. I look at the 5-year historical dividend growth history. And then I also look forward looking. I do look at the 3-year future dividend forecasts and that growth history. And these days, with the stock market, although it was down again today, but with the stock market very much at stretched valuations, I think, the future, looking at the future is tough because we're seeing dividend growth slowing typically, even among, some of the terrific dividend stalwarts out there. So I do look at the future and as well. And then I try to look at the economic moat, like Morningstar talks about, to try to understand just how much sustainable competitive advantage a business may have, whether it's through the strength of their brands or for some kind of structural, maybe oligopolistic reason or monopolistic reason. In the case of utilities, for example, they're pretty much monopolies in their geographic area. So I look for that as well. So I have quite a few criteria I use. And depending on how well I do a weighted average of these criteria, and depending on how well they do, if they do great, then they end up as a core or foundational stock. If they do good, they end up as a supporting stock. And if they do fair, good enough, then they're on the roof. But you can earn your way out of those positions. If a stock starts out on the roof and just continues to perform year after year after year, and maybe continues to raise its dividend through a recession, it can earn its way into higher levels in the house, so to speak. It can move into the walls or into the foundation ultimately. So it really does depend on the stock ultimately.
This is great. There's a lot of things that are in my mind right now to ask you, but one of them is an observation actually. And it's, I've had the chance to interview a lot of people on this podcast, and I'm thankful for all the people who have been willing to say yes to me. But throughout that time, I ask a lot of similar questions, like some of the ones I'm asking you, and how people build their portfolios, things like that. And it seems to me that the DGI, the dividend growth investing community, my observation and experience with this community is that more than any other niche in the market is far more systematized, disciplined, orderly, organized. And I'm wondering, I'd like to hear your thoughts on why. I have some thoughts on maybe why that is, but I'd like to hear why you think that difference may exist in the DGI community versus other aspects of the market.
Well, that's an interesting question. I can't presume to speak for, everyone in the DGI community. I can tell you, why I think that's true for me, and maybe it applies to some other people in the community. Probably not all of us. There are some differences in our approach, but I think I think I'm less risk tolerant. So I think the less willing you are to gamble, to feel like a gambler, the more willing you are to like dividend growth investing. And the reason is because if you're fortunate enough to have a portfolio large enough that you can live off the income that those stocks produce, then it really doesn't matter day to day what the stock price is. It only matters that your Kimberly-Clark, your Coca-Cola, your Philip Morris, whatever it might be, your rock solid stocks are still going down the road, selling their products and increasing their dividend year after year. So you feel like you are a little more, I don't want to say insulated, but you feel like you're not going to hit a point where you have to sell at a bad time in the market, because hopefully your income will just continue to grow and you don't have to think about it in terms of the day-to-day speculation of the market pricing. I started out, and this kind of harkens back to an earlier question you asked me, I started out investing in real estate In my spare time for fun, I bought rental properties, and just like a rental property, a single family home throws off an income when you have renters in there. It's the same thing. I wrote an article on this as well, where each little dividend growth stock is a little house. It's a little dividend house that is sitting there throwing off income year after year. And so just like when you own a rental property, you don't even know or care what that market value of that property is from day to day or month to month. You only care when you buy it. And, 17 and a half years later, maybe if you sell it or do a 1031 exchange to get to that next rental property. Otherwise, it doesn't matter what it's worth because you're not going to sell it. And it's the same thing with a dividend house, a little stock that's throwing off income. Your Kimberly-Clark is going to be there now. It's going to be there in 10 years. People will need diapers in 10 years, all those millennials. So, so whether or not Kimberly-Clark is down 5% today or up 20% tomorrow, it doesn't matter because I want it for the income, just like I want my rental property for the income. So that feels much more logical. And it feels like I have more control over my destiny than just gambling day to day on growth stocks that they will go up, and I have to get a capital return. I have to hope for capital gains. It's the only way I make money. In this case, I hope in 10 years my portfolio is worth a lot more than it is today, but it's in a way should be neither here nor there because it's really about the income the portfolio is generating. And that I can control. I pick the stocks for their income. Now, I can't control it completely. Kinder Morgan is in my portfolio and it cut its dividend significantly when it wanted to use its capital to cover its growth objectives instead of paying its dividends. So, that happens. But the ConocoPhillips is another stock of mine. Same thing, of course, with the energy market the way it is. It cut its dividend. I have both still in my portfolio. I do believe both of them will be fine in the long run. I think we're just in a place right now where they're not. But they're two of 65 stocks that I have. So if I structure my portfolio carefully, a handful of stock cuts or even eliminations will not significantly hurt my income. And that's the goal.
Very well put. That's an excellent answer. I love the illustration of comparing a dividend stock to a rental property. I never thought of it that way before. It makes sense, but I'm not aware of hearing someone compare the two like that. But I like that as far as, because you hear people with focusing on income with their portfolio, and when stock price depreciates and comes up and down, especially when it falls, you'd think that'd be really upsetting or a really big deal. But when you compare it to a rental property, you realize, well, of course you don't want that to happen, but as long as it's back up well, by the time you sell it, if you sell it, it doesn't really matter.
Yeah, and Brian, the other thing too is real estate, like the stock market, has cycles, and real estate has, takes years to work through its cycle. The stock market also sometimes takes years to work through its cycle. And so I'm trying to insulate myself from those cycles, So in rental properties, you can do these things called 1031 exchanges. So if the market's low, I swap into another property that's low. That's a good thing. And the same thing with a dividend stock. If the market is high, it's interesting, if you're sitting in your own house, let's say you own a house and you're sitting in it and you've just retired and the real estate market, and this is your forever home. You're going to retire there and this is the house you're going to live in for the rest of your life. And you turn on the evening news and you hear the real estate market's just collapsed. Your house is worth half of what it was. Are you going to want to run out and sell it? Of course not. And yet in the stock market, the same thing happens and people are running for the exits. And if you've picked your stocks wisely, it's just like sitting in your house. You're sitting in Coke and, Procter and Gamble and Johnson & Johnson. You're not going to need to sell those just because the stock market fell in half, because they're still churning out. They're still doing business. They're still churning out their dividends. So, the utility company's not going to stop providing electricity and people are still going to pay for their electricity. So if you pick wisely, even when the market does go in half, and it will, you're insulated because you're still getting the income you were expecting, or, 95% of it. And you can wait out that down cycle. And that's the beauty of digital or dividend growth investing, is that it provides you with a way to smooth out those horrific stock market cycles that have happened, to all of us.
One more question about the DGI specifically. What do you think is behind the highly engaged DGI community on Seeking Alpha? What do you think? It's like when I look at some articles you've written and then other DGI investors that I've interviewed or whose work I've read, it's not uncommon to see comments on articles in the upper 200s, 300, 400 range. And that's really, really unusual to consistently see that. And it's kind of opened my eyes to just a highly engaged sub-community of Seeking Alpha that I honestly didn't know existed until a few months ago. What do you think? What makes that community so active and lively like that?
It's very interesting, isn't it? Because it's a very supportive community. We're really trying to teach each other. We're all trying to learn, and we're trying to teach each other. And it's people like me who are, just learning it and explaining my own thought processes. But there's financial advisors on there who chime in, that are managing other people's portfolio. I mean, some of these people are, they're professional investors, and they know what they're doing, and they take the time to give free advice. It's just fabulous. And I think it's because, unlike perhaps in the speculative side of the stock market, when you're trying to find that next Facebook or Apple or whoever, it's a little more competitive. It's like, I want to keep my secrets to myself so I can make a fortune, and I don't want everybody else, to know about my, little secret company that I think is going to make me a billionaire. That's not the psychology at all for dividend growth investors. Dividend growth investors feel like, it doesn't take away from me to help you. And if I help you, then you may make a comment on an article that I write or on somebody else's article that's really hits insightful for me, that really has me go, wow, that is a great way to think about it. And so for us, it doesn't take away from any of us to share. And in fact, it only helps us to share. And so we have this positive cycle going where we all are sharing with each other, and we're all providing each other with, our own thoughts about what each other are doing, but in a very supportive and have you looked at it this way sort of way. Not to say there's not disagreement. There is a fair amount of the time, but we do it in a respectful way. Here's how I think about it. You're not thinking about it that way. And that may be because your risk tolerance is different. It may be because you're, 30 years younger than I am. It may be because you're 20 years older than I am, so and so we try to take that into account and talk about, where you are and where your risk tolerance is, as well as part of that may change what your portfolio looks like. A really well-respected author on Seeking Alpha, Chowder, has recently, I think, entered the distribution phase, which means he's entered retirement. Now he's living off his dividend income, as opposed to the accumulation phase where you're still growing your portfolio, you're still working, so you're not having to live off your investments yet. So he's just entered the retirement phase, and he's started talking about how he's making his dividend growth portfolio even more defensive. In other words, he's going even more heavily into consumer staples and utilities, and less heavily into industrials and things that are much more cyclical. Because now that he's relying on the income, he really wants to stay in those very stable growers. And so, you learn about different strategies at different stages in the investment timeline. So yeah, it's a great community, and it's very welcoming. The only time people aren't welcome is when they take pot shots that are not fair to other people. And the community really puts those people in check. It's really nice to see, they'll say, look, that's not the way we act here. Because we're really all just trying to learn and grow. And it doesn't take away from me if an idea I give you helps you. I mean, how does that hurt me? It doesn't. So it really is a terrific group of people who want to make want to meet their own retirement goals, but also are happy to help other people meet theirs as well.
And your description of the DGI community on Seeking Alpha, it makes me want to start getting philosophical about how I wish things worked in the real world. Because, well, the way you, and not to get off topic, but the way you just described the community, being positive, constructive, helping each other, because helping each other helps you as well. And when people come in with, a negative approach or a contra opinion or whatever else, and unconstructive, the community stands up for itself and protects those values. And man, there's so many lessons in that for so many other areas of life. I appreciate you sharing that, and I'll let our listeners connect those dots on their own for now, because we won't do that here on the show. But I really appreciate that description, and I can also see with the DGI community versus, like you said, maybe the more speculative sectors or side of the market, is the pride factor too. Because in the speculative side, you kind of feel the inherent risk in what you're doing, and you can start when someone threatens your opinion, that also it affects your pride, and then also it stirs up fear, because what if you're wrong, and you get defensive, and then all these emotions come into play, and again, people looking out for themselves instead of looking out for each other. And so again, those comparisons are very illustrative. I thank you for doing that. Back to the portfolio specifically, you mentioned, because you have 65 stocks in your portfolio. Is that pretty normal for a DGI portfolio?
Well, it's a lot. No, I would say it's on the high end. Now, there are people, I'm thinking of a commenter on Seeking Alpha right now who says he has over 200 stocks.
Wow.
And actually, there's a couple who have, so there are people who have a lot more. I would say probably many DGI people, not all, would say somewhere in the 25 to 30 range is probably the sweet spot. So at 65, I'm a bit high. And the reason is the way to think about this is about when diversification gets to be good because you're not, let's say you were in 5 stocks, and let's just say you weighted them equally. So your income is equally weighted across 5 stocks. So 20% of your income is each due to one of the stocks. If one of those stocks happens to be Kinder Morgan, as we talked about, who cut their dividends significantly, now you're down to, let's say, they didn't cut it down to 0, but just for illustrative purposes, let's say they went down, you'd be down to 80% of your income if one of those stocks failed. Whereas if it's one of 50 stocks, you're only out 2% of your income, right? So instead of getting 80%, now you're back up at 98%. So the more the better to a point. And in fact, there's a word coined called diversification instead of diversification, diversification, where you've got so many that you're actually making things worse. What you're actually doing instead of seeking alpha, which is to say, instead of trying to do better than the market, which is what seeking alpha means, it means you're trying to do better than the market. You'll end up, if your portfolio is large enough and has so many stocks, you'll end up just emulating the market. So you won't be able to outperform the market because you look too much like the market.
Right.
So there is a sweet spot there. I originally thought 25 to 30. I originally thought 30 to 50 would be my goal. And as the portfolio grows, I don't see going higher than 65. I do think the right number for us is somewhere between 50 and 60. So I'm in fact in the process of, my husband's about 4 years from retirement. I'm 9 years, almost 10 years younger than my husband. So I'm technically, I say I'm going to retire in 7 years. I'm hoping to retire sooner than that, but he'll retire in 4 years. So I'm looking at our portfolio and I'm starting to also make it a little more defensive. So I recently got out of Deere. It's an industrial cyclical stock. I am getting out of my Caterpillar as the Caterpillar reaches my prices that I want it to reach to get out. As I mentioned, I'm getting out of Walmart. I just am not a big fan of retail stocks to begin with. And the dividend growth performance there has been very lackluster. So I'm getting out of some of the stocks that I know I don't want to be in eventually when I can. So I know I've got a few years to do that, which is nice. But yeah, so I would say, to a beginning person, I would say, just start with a foundation, buy the rock solid stocks, the J&Js, the Coca-Colas, the Cloroxes of the world. These are stocks that are dividend aristocrats. They've raised their dividend for at least 25 years or more. Clorox has raised its dividend every year for 38 years, for example, literally. And stay in those high quality stocks. Get started that way. Get your feet wet with the core stocks. And then as you learn about your own risk tolerances, continue to maybe then do a supporting stock and then, end up with your roof stocks later. You have to kind of feel your way to where your boundaries are. For me, I never know for sure where my line is until I've gone over it. That's how I learn, by making mistakes. So I got into BDCs, business development companies. These are companies that loan money to other companies that banks won't lend to give you an idea of how risky they are. I am no longer in any BDCs. And so I learned where my risk tolerance line is. I got out fine. I got out whole, not much more than whole, but whole, pretty much. But so you have to kind of learn where is your line. I would not recommend starting out with anything risky to start with, just to, get started with an Altria or a Procter & Gamble or a Kraft Heinz maybe, and just, a consumer staple or a utility like a Southern Company or a Wisconsin Electric, just to learn how to buy and sell and learn to get comfortable with the rhythms of the market and, just to start learning about how that all works before you get fancy. And that's how I started. And it's a great way to start.
Well, Lynn, as we're wrapping the interview up, is there any other wisdom that you'd want to share, especially with maybe assuming a lot of newer investors listening to the show, any other wisdom you'd want to share with them before we wrap things up?
I would say my two best pieces of advice would be to start with a plan, know what know where you're going before you set off to get there. So, have a target to shoot at. So, you can read a lot and figure out what would that ideal retirement portfolio look like for you. Have that, and I would write it down. Have that in mind before you get started so that you'll be at least trying to take steps that are moving you in that direction and you'll be clear about that. And the second thing is really what I was talking about is also know yourself and know what your own risk tolerance is, both in designing the portfolio and as you build it. Because you can always evolve your thinking, and you will as you learn, but you need to start out with some assumptions, and then you test those assumptions, and consider it a grand experiment that you're continuing to grow and evolve and test, and your house will just get stronger and stronger.
Awesome. Hey, Lynn, this has been wonderful. Thank you so much for your time.
Absolutely. I enjoyed it, Brian.
Likewise. Have a good rest of the day.
Thanks. You too. Bye-bye.
Well, I hope you enjoyed today's interview with Lynn, also known as Dividend House. Remember, you can get full show notes with the links and other details at investorinthefamily.com if you missed anything here today. And if you want to be a part of the online investing conference, simply go to onlineinvestingconference.com or follow the links on the show notes page on my website or show notes on iTunes, wherever you may be finding it. Or you can simply text the word join family, the words join family, to the number 44222. You'll get on my email list where you'll get all the information you need there as well. Thank you. This is Brian, and thank you for joining the family. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.